Welcome back to Investing Talk Podcast.
Great to be here.
Today, we're tackling a question that's definitely on a lot of people's minds. Is Taiwan semiconductor manufacturing a good time to buy now?
Big one.
We've pulled together quite a bit of research, articles, our own analysis, trying to give you a really solid picture of this company's potential right now.
Yeah, give you a comprehensive view.
And hey, while we get into this, if you find what we're discussing helpful, we'd really appreciate it if you hit that subscribe button, maybe give us a like or drop a comment. It helps us out a lot.
Helps get the word out.
And if you're really enjoying these analyses, maybe consider buying us a coffee. That caffeine definitely keeps these sessions going.
It certainly does. But really, our goal today is simple. Take this, seemingly complex investment question.
Right.
And just break it down, make it clear, give you some actionable insights. We've done the legwork, so hopefully you feel more informed.
And honestly, the first look at everything we gathered, it leans pretty positive. The sources seem to suggest Taiwan semiconductor manufacturing looks like a strong buy opportunity.
Yeah, for both long-term folks and maybe even some selective short-term traders.
Interesting.
Based on all that, our initial overall rating for the company comes in at an 8 out of 10.
An 8 out of 10, okay? And the current price is sitting around $232.48. So our analysis points to compelling value, even though, well, it might look a bit pricey at first glance.
Exactly. It seems premium, but there might be good reasons. So where should we start digging in?
Let's start with the bedrock,
the
financials.
Good place to start. And what really stands out with Taiwan Semi is just how consistent they are. Profitability, growth. It's remarkable.
Okay.
So look at 2024. Revenue hit $90 billion. That's up almost 34% year over year.
Wow, 34%. That's a big jump. A strong bounce back from 2023 then.
A very strong bounce back. And it wasn't just top-line sales, net income. That surged nearly 40% to $42 billion.
$30 billion net income.
Which gives you this incredible net margin of about 40.5%. And their operating margins expanded too, up to 45.7%. That tells you they're super efficient and they have real pricing power.
That operational efficiency is key. And it sounds like it's not just the income statement looking good. What about cash flow?
Oh, the cash flow story is maybe even more impressive. Free cash flow in 2024 was $87 billion.
$87 billion.
Yeah. And get this, that's a 203.7% increase from 2023.
Over 200% increase.
Yep. Giving them a free cash flow margin of over 30%. That is just a massive amount of cash the business is generating.
And that kind of cash generation must mean their balance sheet looks pretty healthy.
Exceptionally healthy. Total assets are around $208 billion US. But the really striking thing is their net cash position.
Meaning
they actually have more cash and equivalents on hand than their total debt.
Ah, okay. So they could pay off all their debt and still have cash left over.
Exactly. Think about that kind of financial flexibility in a capital-intensive industry like chip making. It's huge. Their debt-to-equity ratio is super low, just 0.24. Very conservative management.
Makes sense.
And their return on equity, still exceptionally high. They're using shareholder money very effectively.
Okay, so the financial foundation is incredibly solid. They've got the money. They're making money efficiently. How does that translate into their position in the actual market?
Well, that leads us to their market position, which is, frankly, unparalleled.
Dominant is the word that comes to mind.
Absolutely. As of the first quarter of 2025, Taiwan Semi held about 67.6% market share in the global semiconductor foundry market.
Almost 68%. And that's actually up slightly from the previous quarter.
It is, up from 67.1%. Now compare that to their closest competitor, Samsung.
Okay.
Samsung's sitting at just 7.7% market share.
7.7. Wow, that really highlights the concentration, doesn't it?
It really does. It underscores just how much of a leader Taiwan Semi is. And it's not just about sheer volume, their technological moat, their advantage in making the most advanced chips. It's massive.
Especially the smaller nodes, right? The really cutting-edge stuff.
Precisely. Advanced technologies think 7 nanometer and smaller that made up 69% of their total wafer revenue in 2024.
69%. That's a big jump from 58% in 2023.
Huge jump. And listen to this. 3 nanometer technology, the absolute state-of-the-art right now, that alone accounted for 18% of their wafer revenue last year.
18% already from 3 nanometer. That's incredible.
It shows they're not just ahead technologically, they're actively monetizing that lead. They're capturing that high-value demand, especially for AI and next-gen devices. It really locks in their position for the future.
Okay, so financials are rock solid, market position is dominant, tech lead is clear. Which brings us to the big question for investors, right? Is the current price justified? The PE ratio is 27.83. That's a bit higher than the industry average of around 24.5.
It is. It's trading at a premium to the broader semiconductor industry. But, and this is important, how does it compare to its key peers, especially the ones really riding the AI wave?
Good point.
Well, it's significantly below companies like NVIDIA, which trades around 48 times earnings, or Broadcom, which is way up there at like 163 times earnings.
Okay, so in that context, maybe 27.83 doesn't look quite so high.
Exactly. We think that premium for Taiwan Semi is justified. Why? Because of its superior growth prospects and that dominant market position we just talked about. And if you look at the forward PE, based on expected earnings, it's around 25.97. That suggests a more reasonable valuation for the growth that's anticipated.
What about other metrics? Price to sales, price to book?
Price to sales is 13.0, price to book is 9.04. Now, those might seem high in isolation,
Right.
but they actually align pretty well with a business model like this one. It's highly efficient, technology-intensive, asset-light in some ways, because so much value is in the intellectual property and process leadership.
Okay. And you mentioned intrinsic value earlier. Simply Wolfson had an estimate.
They did. Their fair value estimate comes in at $307.28.
$307, compared to the current price of around $232.
Right. That suggests the current price is trading at roughly a 24% discount to what they estimate its intrinsic value to be.
And what that means for you, the listener, is potentially a significant margin of safety built in at current levels.
A cushion, yeah. Now, let's look at the technicals quickly. The charts are showing strong bullish momentum.
Okay.
The stock is trading well above its key moving averages. It's 7.8% above the 20-day, almost 19% above the 50-day, and over 22% above the 200-day. That's a classic sign of a strong uptrend.
And what about momentum indicators like RSI or MLED?
Good question. The RSI, Relative Strength Index, is at 69.49. Now, that's getting close to what traders call overbought territory.
Meaning it might be due for a pause or pullback.
Potentially, but it's not at an extreme level yet. It suggests strong buying pressure, but maybe not unsustainable froth. And the MAD indicator, that's firmly in bullish territory at 9.88, confirming the positive momentum.
Any key levels to watch on the chart? Support or resistance?
Definitely. Key support seems to be around $134.25. That was a recent low. Provides a solid floor. Current resistance is right where the stock is now, around $232.82. It's testing that level. And analysts, their consensus target price is about $242.50.
So about 4.3% upside from here, according to the average analyst target.
Right. And speaking of analysts, the sentiment there has been pretty positive lately.
Seeing upgrades.
Yeah, Needham recently raised their target to $270. Susquehanna bumped theirs to $255. Barclays went to $240.
Okay, so strong bullish calls there. That $270 high target suggests maybe 13–16% upside potential if things go really well.
That's the potential they see. And what's driving all this optimism beyond the solid financials and market share?
It has to be AI, right?
Yeah.
The artificial intelligence.
Absolutely. It's a central theme. AI requires immense computing power, and that means massive demand for the advanced chips that only a few companies, primarily Taiwan Semi, can make.
The scale of demand is just enormous.
Yeah. It really is. Projections suggest that AI-related revenue alone for Taiwan Semi could hit $33 billion by 2026, maybe $46 billion by 2027.
$46 billion just from AI chips by 2027.
And the CEO himself projected something like $90 billion in AI chip revenue by 2029.
$90 billion.
Think about that long-term growth potential. They are, in many ways, the essential enabler of this whole AI revolution.
That's a powerful position to be in.
Right.
So beyond that massive AI tailwind, are there other specific catalysts investors should be watching, maybe short-term and long-term?
Definitely. Short-term, say the next 3 to 6 months, keep an eye on their Q2 2025 earnings report. That's coming up on July 17th. Expectations are for EPS around 1.466 cents and probably strong revenue guidance. Remember, their May revenue is already up 40% year over year.
Strong momentum going into the report then.
Seems like it. Also, look for the rollout of their 2-nanometer technology. That's expected in the second half of 2025. That's another leap forward, widening their lead.
And that usually finds its way into big consumer products, right?
Exactly. There's anticipation that Apple will use Taiwan Semi's 2-nanometer A20 chips in the iPhone 18. That's a huge volume driver.
Okay, that covers the near term.
Yeah.
What about looking out further, say 1 to 3 years? What sustains the growth?
Well, the continued build-out of AI infrastructure globally is the big one. That's a multi-year trend. Then you have growing demand from automotive electrification.
Electric vehicles needing more advanced chips.
Lots more. And also the ongoing expansion of 5G networks worldwide. Plus, don't forget their strategic geographic expansion, those new factories, fabs in Arizona, Japan, Germany.
Right, diversifying away from just Taiwan.
Exactly. That's crucial for mitigating geopolitical risk, which we should definitely talk about.
Yes, absolutely. No analysis of Taiwan Semi is complete without tackling the risks. And the geopolitical one, it's the elephant in the room, isn't it?
Yeah.
U.S.-China tensions, Taiwan's strategic location. How significant is that risk?
It's significant. It's probably the most significant risk factor. Trade tensions, policy shifts, export controls. They're all real possibilities that could impact the company. It creates vulnerability.
But there's also this idea of the silicon shield, right? That the world depends so much on Taiwan Semi that it actually offers some protection.
That's the counter-argument, and it has merit. It's not a guarantee, of course, but the global reliance on Taiwan Semi's advanced chip production is immense. A major disruption would cripple the global economy.
So it creates a strong disincentive for anyone to, well, mess with things too much.
Precisely. It provides a layer of protection, a kind of economic mutual assured destruction, if you will.
Okay. And beyond geopolitics, what are the risks? The semiconductor industry is famously cyclical. Boom and bust.
True, historically it has been very cyclical, but there's an argument that the current cycle might be different, or at least moderated for advanced chips.
Because of AI and other factors.
Yeah, right. The strong structural demand from AI, from automotive electrification, these aren't just temporary surges. They represent fundamental shifts in technology that could provide a more consistent, long-term demand floor, potentially smoothing out some of that traditional cyclicality, especially for the high-end chips Taiwan Semi specializes in.
Interesting perspective. What about concentration risk? They rely heavily on Taiwan for operations and on big customers like Apple and NVIDIA.
That's another valid point. Concentration, whether geographic or customer-based, is always a risk. If something happens in Taiwan or if a major customer shifts strategy,
It could have a big impact.
it could, but as we mentioned, they are actively working to mitigate this. Building fabs elsewhere diversifies geography. And while Apple and NVIDIA are huge, they serve a wide range of customers across many tech sectors. Lastly, there's valuation risk.
Because it trades at a premium.
Yeah. When a stock trades at premium multiples, it's naturally more sensitive to any disappointments in earnings or negative shifts in market sentiment. However, the strong fundamentals and clear growth path we've discussed seem to support the current valuation. It feels like a premium paid for quality and growth.
Okay, so pulling this all together, we've looked at financials, market position, tech, catalysts, risks. Our overall rating remains that 8 out of 10. What's the final recommendation?
Based on everything, our recommendation is a BUY for long-term investors, if your time frame is, say, 12 months or more.
And for shorter-term traders?
For them, it's more of a selective buy-wire, maybe looking at a 3 to 6 month window, being mindful of entry points and momentum.
Speaking of entry points, you mentioned some target zones earlier.
We did. For potentially better risk-adjusted returns, that primary entry zone looks like $215 to $225, ideally on a bit of a pullback. If we see a broader market correction, getting in between $200 and $210 would represent excellent value in our view. We'd probably advise against chasing it much above $250 as the risk-reward starts to look less attractive up there.
And how should someone think about sizing a position in their portfolio?
Good question. For a typical long-term investor, maybe a 3–5% allocation makes sense. If you have a more growth-focused portfolio, you might go a bit higher, perhaps up to 7–8%.
And for more conservative investors?
Maybe start smaller, 2–3%, and consider accumulating gradually over time, perhaps using those entry zones we mentioned.
What about that short-term trader? Any specific strategy points?
For them, entry might be considered in that $225, $230, $205 range, but only if momentum confirms. Definitely use a stop loss, maybe around the $200 psychological level.
And profit targets?
Could look at $250 as a first target, maybe $270 as a second aligning with that high analyst estimate, and then potentially $300 or higher for a longer-term breakout move.
So stepping back from the immediate numbers, what's the core long-term investment thesis here? Why own this company for years?
The core idea is that Taiwan semiconductor manufacturing represents a powerful way to compound your investment through the ongoing global digitalization and especially the AI revolution.
It's foundational.
It really is. It's tech leadership, market dominance, strong financials. It makes it arguably a core holding for any serious technology-focused portfolio. We see a potential 3 to 5 year price target in the $350–400 range, assuming continued AI growth and successful market expansion.
And the keys to them achieving that.
Three main things, I'd say. One, maintaining that crucial technology leadership in advanced nodes. Two, successfully navigating the geopolitical complexities. And three, executing on those ambitious capacity expansion plans outside of Taiwan. They really are the critical enabler for so much future tech.
Okay, so to wrap up this deep dive, Taiwan semiconductor manufacturing clearly stands out. You've got incredible financial strength, dominant market share, that undeniable technological edge, and really powerful growth drivers, especially from AI.
Right. And while the geopolitical and cyclical risks are real, and we absolutely need to acknowledge them, the company's unique Silicon Shield status and their strategic diversification efforts are actively working to manage those concerns.
So maybe a final thought to leave our listeners with.
Yeah, here's something to ponder. Consider Taiwan Semi's unique position. They aren't really a direct competitor in the AI arms race itself, like, say, NVIDIA versus AMD. They're the enabler for almost everyone involved. What does that tell you, perhaps, about finding resilient investments within these huge, rapidly evolving technological shifts? Investing in the picks and shovels versus the gold miners, so to speak.
That's a great question. Investing in the enabler rather than trying to pick the ultimate winner. Definitely something for you all to think about and its broader implications. Thank you so much for joining us for this analysis today.
We hope this was valuable. Keep exploring, keep staying informed.
And we'll see you back here for the next deep dive.